All right, joining us once again here on the Matthew Filipowicz Show is Nick Baumann. Nick's work has been seen in The Economist, The Atlantic, Washington Monthly. He is the news editor at Mother Jones Magazine, which you can find at motherjones.com. You can also find him on Twitter at Nick Baumann. Nick, thank you so much for being on the show again.
Thanks for having me.
All right, so Nick, you have a great article up in the January-February issue of Mother Jones and at motherjones.com entitled "Too Fast to Fail? Is High-Speed Trading the Next Wall Street Disaster?" It's really an amazing and important piece. Why don't you tell us all about it?
So I actually got some pushback on the story that I think is interesting and illuminating, where people said, well, there's this crisis on August 1st where a company called Knight Capital had a runaway trading algorithm, routing algorithm actually, runaway computer program that resulted in all these unintended trades being made on the stock market, and it cost the company tons of money and actually basically made the company insolvent. They had to bring in new investors to take control of the company after that. And a lot of people, when I wrote this article, said, well, we already know that this sort of the sort of very fast trading driven by computers is a problem. We saw it with Knight Capital. But the point that I was trying to make with the story is that actually Knight Capital is not even close to the sort of problem that we should worry about from this. As one of the people I spoke to said, it's not even close to the worst case scenario. The worst case scenario is that you don't have one company fail. You have a series of cascade events where a bunch of different companies are brought down by having similar problems in a very short period of time, and that's what we really have to worry about. And that hasn't happened yet. But one of my sources said it's not a question of if this happens; it's a question of when. And so that's scary stuff.
No, it definitely is. And again, we're talking about just the very concept of high-speed trading, which is how, Wall Street, these trades are made in the microsecond, where millions of trades are constantly being made, not by human beings saying, hey, I want to buy this stock, sell this stock, the kind of the old school way of, holding up papers, on the floor of the trade. What's happening is all this stuff is now automated by computers, and it's also like the way these trades happen are written by codes. And initially, you write in the article about this firm, Knight, which isn't that big of a firm, correct? It's actually a pretty small firm. They had some weird abnormality in their trading software, and this is again not a gigantic firm, but what just their little problem, which cost them millions of dollars, also had a massive effect on the market itself, correct?
Yeah, that's the thing. So it cost them about $10 million a minute. It was running for about 45 minutes, so it's nearly $500 million. It made the firm insolvent, but it really swung trading volume on the New York Stock Exchange. You saw that within 3 minutes of this starting to happen, trade volume, the number of trades going back and forth, had more than doubled the previous week's average. So people knew that something weird was going on, but it still took them 45 minutes to resolve this problem. And when you're talking about companies that can literally make 1,000 trades a second, without lifting a finger, I mean, that's no problem, 1,000 trades a second. 45 minutes is an eternity. And it's stunning that it took so long to shut this down. And the real concern is that you see this happen either with a series of companies or with a much larger firm, and a firm that's systemically important, as people like to say. And then you could really have a real problem.
And so you write in the article about how a lot of firms are actually really, they're installing even faster, I guess, internet connections and and software do this even faster than they're doing it now, and they're connecting these computers to even faster networks that we don't even that it makes it will make it even faster than it is at this moment.
Yeah, it's crazy. There's this huge race because there's some estimates that say if you had a systemic advantage over your competitors of just 1 millisecond, 1,000th of a second, over the course of the year, that could boost your earnings by $100 million. That's one estimate. And that's a huge incentive to try and move as fast as possible. This is why you see trading companies coming, even though real estate is so expensive in the New York area and near London, coming back closer to these hubs where trading happens, because the actual physical distance that signals are traveling across wires matters, because it takes time, even at the speed of light, it takes time for that information to travel back and forth. And so there are companies that make money by laying the straightest possible lines of cable between New York and Chicago. Every extra foot of fiber optic cable adds about 1.5 nanoseconds of delay, and each extra mile is about 8 microseconds. And that's real money to these companies, especially when you're talking for the course of a year and tens of thousands or hundreds of thousands or millions of trades realistically. These are companies that are making usually fractions of a cent on each trade, so they really it's all about volume, and so the speed is very important.
You also write about, and again, I'm talking from talking to Nick Baumann from Mother Jones magazine. You talk about the flash crash that happened in May 2010, and kind of the craziness that surrounded that. So describe what actually happened on that day.
So you saw in this very short period of time, no one knew in real time really what had happened, but you saw in this really short period of time that the stock market dropped. It was already down about 400 points, and in a very short period of time, a couple minutes, it dropped another 600 points. So it's down 1,000 points. And the thing was that it wasn't the drops in stock prices weren't very consistent. They were stocks that you wouldn't expect to be so far down were very far down, and you were seeing very unusual prices, such that during the same second, at one point, shares of one firm were trading at both 1 cent and $30.
Whoa!
And so there's a lot of volatility, and what happened is that usually the rule on Wall Street and the rule with trading firms is if you don't understand what's going on with the market, you got to get out. And so a lot of the companies that normally provide the liquidity for the market, and make it easier for retail investors to buy and sell, stopped trading because they didn't know what was going on, and that sort of accelerated the problem. Basically you saw $1 trillion in shareholder value wiped out in a couple minutes. Now, eventually the market rebounded pretty quickly. It still closed down. But it was really scary for people because there wasn't really a good explanation for why this had happened. And the SEC and federal regulators spent months and months trying to figure out why this had happened. And ultimately they came to believe that a single trade on a single financial product, it was a very large trade, had sort of triggered this chain reaction where the market had just gone crazy. The crazy thing about this is that report, that analysis by the regulators, that took 5 months.
Wow.
And so you're talking about something that happened in 5 minutes.